Hello friends, I hope you're having a great day. In this session, we want to examine some topics much more deeply. Look guys, we want to see overall who are the main participants and constituents of the global financial markets. Well, the most important constituents of these financial markets are governments. What does that mean? It means that central banks, like the Federal Reserve in the United States and the central banks of other countries, are the first and largest traders in these markets. After them come financial institutions, which we've often heard about. There are a number of financial institutions whose job is to manage people's accounts, engage in large-scale investments, or, for example, operate within the market itself. In Iran, you've probably heard of the Teachers Investment Fund or the Bank Employees Investment Fund and so on. These companies, these holdings have been established to manage the budgets entrusted to them, and in a way, they represent a large segment of society. They are responsible for managing the money of this group, making sound investments, and make investments in young financial markets. There are legal entities, which are the companies we know, and there are individuals like you and me. So let's start from the very beginning and clarify this together. Alongside the European Central Bank, alongside the US Central Bank, the Federal Reserve, and let's be alongside these major international financial institutions and start trading with them. For example, if we start trading euro to dollar, or if we place a buy order on euro to dollar, we need to see in the psychological flow that is about to happen in relation to the existing fundamentals, news reports, meetings, conferences, and so on. The meetings that are held, the direction in which government policies are headed, the current inflation, the interest rate, all of these are part of the fundamentals. We will discuss these news analyses together. Alright, let's see how this calculation works during the market's trading hours. Let's point out that international markets, according to our time, start operating from Monday to Friday, beginning with the easternmost banks in the world. We know that Tokyo, London, and New York, these are the three main markets where we can monitor our trades 24 hours a day. Every bank that opens, Tokyo, London, New York, just like in our own country, each country is required to operate for 8 hours. That's their working hours, the business hours, and they can keep the market open during that time. Of course, there are also free markets like Australia and New Zealand in between. But let's see how these work according to Iran's time. Well, when the Tokyo market opens at 8 a.m. local Tokyo time, on Monday, that's 1:30 a.m. in Iran, Tokyo keeps the market open for 8 hours, and then when it's 8 a.m. in London, it's 9:30 in the morning in Iran. So from 1:30 to 9:30, Tokyo keeps its market open for 8 hours, then it closes, and London enters the market. When it's 8 a.m. in London, which is 9:30 a.m. in Iran, London also has 8 hours. London keeps the market open until it reaches 5:30. After that, when it's 8 in the morning in New York starts and keeps the market open for 8 hours. This is a schematic and an example to help us better understand how this market operates 24 hours a day. If we want to see this on a map as well, it's clear that the markets open from the easternmost point of the world, Tokyo. Then it moves to London and then to New York. All right. Now, we want to talk a bit more about the Forex market and currency pairs. Why do we say pairs? Currency pairs? Because it's always about buying one currency against selling another, guys. In the Forex market, when we say we're buying AUUSD, in reality, we're not actually buying euros or dollars. We're not buying euros or selling dollars, nor are we selling dollars or euros. We can't actually do that. This doesn't happen. We don't buy or sell the actual units. What we buy and sell is the value between them. Let me give you an example. For instance, when you look at the EUR-USD chart, you see the price units, for example, at 1.18324. So what does this mean? It means that the euro, which we'll get familiar with in a moment, is calculated in this way. Compared to the dollar, the difference between these two currencies is that 1 euro equals $1.18. But we can easily understand this ourselves. For example, here in Iran, when we say the dollar is now at 25, it means the euro is roughly around 27. That is, it's 1.18 higher than the dollar. And where does this rate come from? From the global market? How do they know today at the exchange office how to change dollars or euros? How do they determine the rate between them? They have to calculate it. Right here in the Forex market, they look at the euro-dollar price chart. They look and say, okay, what is the euro to dollar rate? Right now it gives us an output, and based on that, you have to exchange. Guys, there are some Forex currencies that are no longer called currency pairs, generally speaking. In Forex, we have to refer to the currencies as pairs. For example, we say euro dollar or pound USD or CAD JPY, etc., so that we refer to the country's currencies together because they are paired together. But there are some currencies, these currencies have become so well known that no one really comes. Let me put it this way. To give you a bit of the professional prestige of this market, people don't say euro dollar buy, for example, for euro USD, or the way we might casually say euro dollar in our own language. They say euro for euro USD, cable for GBP USD, Swissy for USD CHF, Loonie for USD CAD, and Kiwi for NZD USD. Now, each of these has its own history. The Kiwi is the only rare bird that now only remains in New Zealand, and for example, it has a special significance for them. It's very valuable to them, like the Iranian cheetah is to us. That's why, for example, on their NZD USD currency, they use the name Kiwi. Now, in a general overview, let's review the world's most important currencies once more. We've probably heard them many times, but it's good to mention them here as well. EUR USD, GBP USD, JPY, CAD, NZD, AUD. Maybe some of you didn't understand what I just said. For example, maybe you only caught Euro and Euro USD. But today, I want to teach you how. When we mention a currency pair or just a single currency, we know which country that currency belongs to and what the currency unit of that country is. Because all this information is hidden within the name itself. Let's see together. When a currency is symbolized, its symbol is made up of 3 letters. The first 2 letters are the abbreviation of the country's name, and the last letter is the first letter of the currency's name in that country. Let's look at a simple example together. What does USD stand for? The US at the beginning is for USA, United States of America, and the D is the first letter of dollar, okay? So it becomes USD. Now can you see how this works? What does AUD mean? AU is for Australia, and D is the first letter of their currency, dollar. AUD means Australian dollar, USD means US dollar. Similarly, for example, JPY. JPY is the Japanese yen, yen. The last letter, as we agreed, is the first letter of the currency name of that country, and the first 2 letters are the abbreviation of the country's name. Friends, what do you think CAD is? The D at the end probably stands for dollar, and CA at the beginning is for Canada. So, Canadian dollar, CAD is the Canadian dollar, NZD is the New Zealand dollar. Let's give an Iranian example too. IRR stands for Iranian Rial, okay? So from the symbol that now from here on, when I say, for example, CAD to NZD, you know what I mean. I'm talking about the Canadian dollar to the New Zealand dollar when I say Euro GBP. You know that I'm talking about the euro in relation to the British pound. GBP stands for pound, the British pound, right? Well, there's a very important point that we need to mention right now. All right, guys, let's take a moment to talk a bit more about the concepts of ask and bid, and specifically how to read the price correctly. You see, our market is what we call a two-sided market, which means that whenever we decide to enter the market to trade, there is always going to be a specific price set for buying. There is also a price for buying and selling, which we call the bid price and the ask price. These 2 prices create a difference between them, which is known as the spread in trading. The spread is what the broker profits from. Let me explain the spread, or how the broker makes money, in simple terms. What benefit does the broker get from connecting us to this market? In what ways can the broker earn income from us? It's like a brokerage office, like an exchange, just another broker. When we enter an exchange, today the price of the dollar is 25,000 toman. For example, you walk into an exchange office and say you want to buy dollars. They say it's 25,100. If you say you want to sell, they say it's 24,900. Basically, they're charging you a spread. Is it only in exchange offices? No, it's in all businesses. You go into a gold shop, right? They say, sir, today gold is 1 million. You say, okay, I want to buy. They say, even if you want to buy this gold, 1 million? And for example, if it's a 50-gram piece, that's what it comes to. If you say you want to sell, they say 950. Basically, there's a margin on buying and a margin on selling. Whichever one you choose, there's a difference. They take a profit after all. And we all know that every dealer makes a profit from the difference between their buying and selling prices. In our financial markets, we know this as the spread. So let's see what this spread and ask price actually are and what causes their difference. The spread is simply the difference between buying and selling prices, guys. The ask price is the price at which the broker sells to us. It's called the ask price. Just like in In the next session, I'll fully explain how to add the ask price to our charts. Because the price shown there, meaning for those of you who have installed MetaTrader or are using MetaTrader, you only see a single price, which is the bid price. And if you haven't installed it yet, we'll talk about it in detail in the next session. The price that appears by default in MetaTrader is the bid price. The bid is the price at which the broker buys from us, right? But the ask price isn't automatically shown on the MetaTrader chart. So we add the ask so that whenever we're entering a buy or sell, we can see the difference between these two or the distance between the ask and the bid. We know what state the spread is in, whether the spread has widened, or as they say, the spread is high, or the spread has narrowed. It's good when it's small. Or there are some currencies whose spreads are very high, and there are some that you really shouldn't trade much with. Try to stick with the major currencies. If you're just starting out, take this advice of mine to heart. At the beginning, work with currency pairs that are majors, or at most minors, but focus on the majors or main ones. Why? To put it simply, they're like the stars of the market because they have a lot of traders and their spreads are low. Let me give you a simple example. For instance, in every business they say there's a certain product that's essential, even if it doesn't seem special. But if that product isn't there, customers won't bother coming to you. In Forex, the major or main currency pairs are like that essential product for every broker. They have to be available because if they're not, if something like XAUUSD isn't offered, people won't even consider opening an account with that broker. Because it's something everyone has and it's highly competitive and difficult to manage. They can't raise the spread on it, so the EUR-USD or major Forex pairs always have the lowest spread. So now we've understood that the difference between the buy and sell price is what we call the spread. Spread exists in every business as well. We've really simplified it so you can compare it to your own business. If you own a stationery store and you buy a pen at one price and sell it at a higher price, that's called the spread. Now, in the market, we've become familiar with its economic term. Okay, so just like we make a profit in our own business, the broker also earns from the spread difference. They make a profit from us, but where's the main point? It's here. The spread that the broker takes depends on the volume of the trade we're making. It's very negligible, extremely negligible, not 10%, not 5%, not even 2%. It's just 1,000th of a percent, really tiny. Let me give you a real example. In the euro-dollar pair, the spread is about 3 to 4 points. We'll get fully familiar with pips and points later on. It's the unit for measuring price on the chart. When we want to buy one standard lot, which is $100,000, the broker charges us a 3-point spread on $100,000, which means $3. If it's a 4-point spread, that's $4 on $100,000. We're making a purchase, but we pay $3 as commission. Let me clarify this here so you don't think, wow, the spread can be a lot. Don't go comparing it to real estate in Tehran, where you sign a contract at an agency. If you buy a house for $1 billion, you have to pay, say, $10 million as commission. No, it's not like that here. If you buy $100,000, the commission is $3. If you sell $100,000, the commission is $3, okay? I'll explain all of this in detail later so your mind doesn't get overwhelmed. There's no scary music here. Just say it. Why did all this become foreign? Why did the terms get so strange? No, we'll simplify everything. Don't worry about any specific terms at all because we've included simplification factors for all of them for you in the package, plus you'll have full support alongside you. We dedicate all this time so that we can solve any problem you might have. So up to this point, we've become familiar with the spread, which is the difference between the buy and sell price. So we have one price called the bid and another price called the ask. Basically, we say bid line and ask line on the price chart. It's clear because they show it to you on the chart. Now we want to talk about lot size or the volume of your trades. Guys, there's a standard in every business. For example, when we want to talk about weight, what is the unit of measurement for weight? They say kilogram or gram. We have a specific unit when we talk about liquids. We ask, what is its unit of measurement? They say it's liter, like how many liters of water, how many liters of milk, right? In the financial market too, in order to have a common standard among all brokers and all companies around the world, so that everything is unified, they started using the term lot and said, we'll use this as our standard. One lot, and each lot is equivalent to 100,000 US dollars. So they set this for themselves. They determined a specific and defined volume so that you, me, and anyone else, since it's international, no matter what language we speak, one lot is the same for all of us. It's the unit of measurement. It's the volume that represents the amount of money we're trading. So a lot is a standard volume. Now, standardization made one lot equal to 100,000. But this doesn't mean that you really have to use a full lot, since a lot is 100,000 in each trade. Do we really have to trade exactly one lot? Or what if we want to trade more? What about less? Guys, one lot is just a standard unit, like saying every person should weigh exactly 100 kilos. Well, can't someone weigh 50 kilos? Can't they weigh 150 kilos? Of course they can. So a lot is just a unit. The standard is $100,000, right? Someone might say, I want to trade half of that. Well, it's very simple. They trade half a lot. Someone else might say, I want to trade a tenth of it. Well, a tenth of a lot is $10,000. Or maybe someone says, I want to trade double. That would be $200,000, but it all has a standard measure. So based on that standard measure, we can calculate amounts lower or higher than it. And there's something else I want to point out here, guys. It's not necessary for the money corresponding to one lot or a tenth of a lot or any volume that enters the market to be the total amount of our money. Because the beauty of the international financial market is this: the credit that the broker gives us in the concept of leverage, or the same credit that the broker provides to us. We'll talk about it in full detail, that the leverage of our account or the credit of our account helps us. For example, with a leverage of 1 to 100, out of this 100,000, you only pay 100. The broker pays the remaining $99,000, and in the section about trading volume, I'll explain leverage in full detail. All right. There's another criterion we need to know here from the financial market. Guys, these are some very basic and simple principles that we at least need to know to get started. We need them on a page like a trader's, because there you can't just say, that's enough, there are no stocks. You can't just say, well, buy me 10 shares, buy me 3 shares, buy me 1,000 shares. Here, you have to specify the volume you want to trade by giving your order in lots. That was one topic. The second topic we need to know is this. What is it? It's how to calculate price using pips or points. For example, if we've bought a stock, we say that 1,000 tomans has become 1,100 tomans, right? But in the global market, that's not the case, because we're dealing with the difference between two currencies. The price doesn't simply increase or decrease in a way that we can measure it like that. So just like when we want to measure a physical distance, we might say something like, we can use meters, kilometers, and these standardized measuring units, starting from centimeters and going up. The amount of movement, look, on the chart, the amount of movement that the price can make, let me actually draw it here for you. Look, imagine this is our chart, right? Imagine this is our chart. We said on this side we have the time axis, and on this side we have the price axis. Imagine our chart, our graph, has moved from here to here. This difference, the movement shown on the chart, is the change from price X to price Y over time. This y-axis difference that we've moved, we can't say it's gone 5 meters or that it's increased by $10. That's not how it works. We say how many pips it has moved. So a pip, or even a smaller unit called a point, is used for what? It's the unit for measuring price movement. On the time axis, it's much simpler. I'll explain it to you now. So first, let's see what a pip is. We said, for example, if our unit of measurement is a step, it's 1 step, 2 steps, right? Here, our unit of measurement for the distance that the price travels is the pip. A pip, back when trading volumes weren't as high as they are now years ago, for example, 10 or 15 years ago in the world, or even earlier, the pip unit was like this. If we wanted to write 10 numbers, 1, 2, 3, 4, 5, 6, and so on, right? The pip unit worked in such a way that it would go from 1 to 2, from 2 to 3, from 3 to 4. Then trading volumes increased. They realized that if it jumps from 1 to 2 all at once, especially when it's on the closing, there's a large volume being traded as well. Let's add the point to this market. Or it's also called a pipette. What does that mean? It means they said between 1 and 2, for example, 1.1, 1.2, 1.3, up to 1.9, and then after that it becomes 2, right? So 10 smaller units were added in between. It's like how centimeters and millimeters work. Previously from 1 to 2, there was just 1 unit, and the next unit would be 2. Then it would become 2, then 3, 4, 5, and so on. Now they say that the numbers between 1 and 2 have become more valuable. Why? Because the volume of transactions has increased. Let me give a simple example so we can understand this more easily. The dollar is 20,000 tomans, okay? And the next price would be 21,000 tomans, and the next price would be 22,000 tomans. Well, if we were supposed to buy just $1, a difference of 1,000 tomans wouldn't really matter to us if you can. The next 20 tomans is 21,000 tomans. If they said 21,922, it wouldn't make much difference for us. They'd say 20, 21, 22, 23. But when we're supposed to buy $10,000 or $100,000 or even $1 million, even 100 tomans, or rather even 50 tomans, becomes really valuable when you're buying in such large amounts. Just think about it. So now they've come and said, instead of considering 20,000 to 21,000 tomans as just one unit, we say 21, then 121, 221, 321, 921, and then 22, right? So it's 2021, 2100, 2200, 2300, up to 2900, and then it becomes 21. Now there are 10 numbers within each 20. Standardizing the music, because as the volume of trades gets larger, those smaller units become more valuable within the chart itself, just like for a trader. This difference between pip and point will cover it completely. We'll work with it, so don't worry about any of these issues. Well, in the basic case, it's always the fourth digit that we read. The numbers inside the chart, the fourth digit is called a pip, and the fifth digit is called a point.